Real estate exam questions with answers and explanations, part number 6. What is a loan-to-value ratio, LTV? A. The ratio of the buyer's credit score to loan amount. B. The percentage of loan compared to the property's value. C. The seller's net proceeds after closing. D. The buyer's debt compared to income. Correct answer, B. The percentage of loan compared to the property's value. LTV measures the loan amount against the appraised value or purchase price, whichever is lower. Lenders use it to assess risk. For example, a buyer borrows $180,000 to purchase a $200,000 home, the LTV is 90%. This means the lender is financing 90% of the property value. What is the purpose of PMI, private mortgage insurance? A. To protect the buyer if the seller defaults. B. To ensure the buyer's job stability. C. To protect the lender if the borrower defaults. D. To cover property taxes. Correct answer, C. To protect the lender if the borrower defaults. PMI is required on conventional loans with less than 20% down. It reduces lender risk if the borrower fails to repay the loan. For example, a buyer puts 10% down and pays monthly PMI until equity reaches 20%. This protects the lender during higher risk periods. What is a prepayment penalty? A. A fee for late payments. B. A charge for paying off a loan early. C. A tax penalty for refinancing. D. An appraisal fee. Correct answer, B. A charge for paying off a loan early. Some lenders impose a penalty if the borrower pays the mortgage off ahead of schedule. These are less common today. For example, the buyer wants to refinance in year 2, but a prepayment penalty applies. This means they'll owe a fee for early payoff. What is an origination fee? A. A fee charged to start a loan. B. A fee for legal representation. C. A title insurance cost. D. A charge to cover inspection. Correct answer, A. A fee charged to start a loan. An origination fee is paid to the lender for processing and funding the mortgage, usually expressed as a percentage of the loan. For example, a 1% origination fee on a $250,000 loan equals $2,500. This is a standard lender charge at closing. What is an adjustable rate mortgage, ARM? A. A loan with a fixed interest rate for 30 years. B. A loan with monthly payment adjustments based on inflation. C. A loan where the interest rate changes after an initial fixed period. D. A loan where the lender controls the payment schedule. Correct answer, C. A loan where the interest rate changes after an initial fixed period. An ARM offers a lower initial interest rate, which later adjusts based on market indexes, often annually after the fixed period ends. For example, the buyer chooses a 5/1 ARM, fixed for 5 years, then adjusts annually. This means lower early payments with potential future increases. What does points mean in mortgage financing? A. Penalties for late payment. B. Prepaid interest to lower the interest rate. C. Amount borrowed above appraisal. D. Lender credits for inspections. Correct answer, B. Prepaid interest to lower the interest rate. Points are upfront payments made to reduce the loan's interest rate. 1 point equals 1% of the loan amount. For example, the buyer pays 2 points on a $300,000 loan, $6,000, to lower their interest rate. This buys down the rate to reduce long-term payments. What is a balloon mortgage? A. A loan that includes property insurance. B. A loan with monthly payments that don't fully amortize. C. A loan backed by the government. D. A loan for buyers with poor credit. Correct answer, B, a loan with monthly payments that don't fully amortize. Balloon mortgages have lower monthly payments but require a large lump sum payment at the end of the term. For example, the buyer makes monthly payments for 7 years, then owes the remaining balance in full. This means the final balloon payment is large. What is the debt-to-income ratio, DTI, used for? A. To calculate title insurance fees. B. To determine buyer's loan eligibility. C. To set the appraised value. D. To measure home equity. Correct answer, B. To determine buyer's loan eligibility. Lenders use DTI to compare the borrower's total monthly debt to gross monthly income, ensuring they can manage the loan. For example, the buyer earns $6,000 a month and has $2,000 in debt. Their DTI is 33%. This helps lenders evaluate affordability. What is the main role of a mortgage underwriter? A. To record the deed at closing. B. To inspect the property for code violations. C. To evaluate risk and approve or deny the loan. D. To draft the purchase agreement. Correct answer, C. To evaluate risk and approve or deny the loan. Underwriters analyze credit, income, debt, and property value to decide whether a borrower meets loan guidelines. For example, the underwriter reviews the buyer's file and issues a conditional loan approval. This step is required before final loan commitment. What is an escrow account in mortgage financing? A. A savings account for personal use. B. A temporary fund held for title review. C. An account used to hold funds for taxes and insurance. D. A payment reserve for home repairs. Correct answer, C. An account used to hold funds for taxes and insurance. Lenders collect monthly escrow payments to cover property taxes and homeowners insurance, ensuring those bills are paid on time. For example, each month, the buyer's mortgage payment includes escrow for taxes and insurance. This protects both the lender and the borrower from future liabilities.